China threatens to strike back at the US over the escalating trade retaliation with their own 34% tariffs on US goods, and they've also banned some American companies from their markets. And as expected, they are also trying to use their vast monopoly on rare earth elements to try and put a chokehold on the tech supply chains. And yet, in reality, this response from China is modest in comparison to the huge levies that the Trump administration has put down on them. And I think that this signals a problem for China. See, they know that they had to respond to some degree to keep appearing from being weak. But this response is tepid because they don't want the U.S. to increase the tariffs. This belies a weakness with the communist empire that the rest of the news media is ignoring. The truth is, their economy isn't the glowing success that they tell the world that it is. Despite their continual propaganda that their economy is growing by 5% in 2025, which magically is the same as it was last year, the reality is behind the Iron Curtain, deep economic woes are churning. Let's take a look at China's property sector. Once 25% of the GDP is now a deep, muddled mess. Evergrande's 2023 collapse still echoes throughout their country, and new home sales have dropped by 20% in 2024 alone. Local governments are drowning in $13 trillion of debt and are selling assets to try and stay afloat, and yet 40% of the revenues is tied to land sales that aren't rebounding. And then there's youth unemployment, which officially fell to 15%, down from 17%. But that's after the communist regime tweaked the metric to make it appear to not be so bad. The real jobless rates for grads could top 20% per private estimates. And consumer confidence is also shaky within the CCP. Retail sales growth slowed to 3% in 2024, which is far below pre-COVID norms. And when it comes to trade, China is also on shaky ground. Trump's earlier tariffs already took a bite out of China this year alone. U.S. imports from the regime fell 15% in quarter one. Now, they tried to offset this by rerouting to the Association of Southeast Asian Nations and to Europe to cushion the blow, and yet global demand is softening, which is dangerous for the communist empire and their survival. And now that you add to this the Chinese government threatening to put a chokehold on the all-important rare earth export, which is required for technology to hit back at the U.S., they are risking alienating buyers long-term. And I don't mean just the U.S., but around the globe. And the yuan's value is still stable at 7.1 to the dollar, but capital outflows hit $50 billion in March, hinting at quiet panic among the elites. Behind the scenes, my friends, energy shortages is looming in China. Coal stocks are tight, and renewables haven't yet panned out to fill in the gaps for the country. There were factory shutdowns that spiked 10% this past winter, per satellite data, despite official denials by the Chinese government. And get this, you probably haven't heard much about this thanks to the vast censorship from the Chinese government, but there has been a lot of social unrest within China. For example, protests over unpaid wages and housing scams doubled in 2024, although news about them were quickly silenced. So no matter what you hear from the mainstream media right now, the truth is China is in a very precarious position. There is a debt to GDP ratio that is nearing 300%. They have an aging population problem, which means a shrinking workforce by 2030 and a middle class that is squeezed by stagnant wages and pricier imports. And because of this, foreign investors are spooked. The FDI dropped 30% in 2024, and Shanghai Stock Index was already down 10% since January. Now, this doesn't mean that China is in free fall yet, but they are certainly playing with fire. Beijing will do what they can to hide their mounting problems, just like the USSR did with altered stats and propaganda. But the strain is real. Property, debt, and jobs are the edge of a knife that could pierce the Chinese empire and turn into an ugly economic crash if global pressures like the USA tariffs continue to keep mounting. And they know this. So what do you think the Chinese government will try and do with the US tariffs at 54%? Well, right now, Chinese goods are losing their price edge in the U.S. thanks to Trump's tariffs, and so they will try to move their goods elsewhere, which is leaving the rest of the world bracing for a flood of Chinese exports. The EU, for example, is on high alert. Ursula von der Leyen warned of Chinese dumping and swears that they will not absorb global overcapacity. And Southeast Asia, already tariff hit, think Vietnam 46% and Malaysia 24% by Trump's tariffs, fears a deluge as China reroutes exports to them. And then there's Brazil's soybean farmers who might gain if China shifts from the U.S. suppliers, but their steel sector is reeling from Trump's levies. And then there's Japan and South Korea, which, despite their own tariffs, might see cheaper Chinese inputs if Beijing pivots. And so global supply chains are scrambling. Companies like Stellantis are cutting jobs in Canada and Mexico, while GM boosts U.S. production. Now, the EU, which will likely have the biggest impact on China's plan to find alternate buyers, had a problem with China's glut of cheap products even before Trump's massive tariff hike on the CCP. In fact, even before Trump got back into office, the European Union was already deeply worried and unhappy with China's flood of these products into their bloc. To back this up, let's take an article from the left-wing news rag CNN. This was published over a year ago. So this is during President Biden or President Vegetable's reign, his last year in office. This article is titled, "A Glut of Cheap Chinese Goods is Flooding the World and Stoking Trade Tensions." Let's see. China's factories are churning out more steel, cars, and solar panels than its slowing economy can use, forcing a flood of cheap exports into foreign markets. The oversupply of Chinese goods in key industries is stoking tensions between the world's biggest manufacturer and its major trading partners, including the United States and the European Union. Its global trade surplus in goods has soared and is now approaching $1 trillion. The United States and the EU are fretting over potential dumping by China. Boy, this sounds familiar. That is exporting goods at artificially low prices, with electric vehicles among the products caught in the crosshairs. The president of the European Union Chamber of Commerce in China told reporters earlier this month that the United States and Europe cannot just accept that strategically viable industries constituting the European industrial base are being priced out of the market. But China needs to increase exports as a key measure to revive its economy, which is grappling with protective property slump, weak household spending, and a shrinking population, among other problems. Beijing is now focusing on higher value exports after investing billions into advanced manufacturing, but the move is badly timed, coming amid slower economic growth globally and a shift by Western consumers from pandemic-era spending on goods to travel and leisure. And it also is coming up against a push by Europe and the United States to reduce their dependence on China and boost local manufacturing, creating jobs, including through the Net Zero Industry Act and the Inflation Reduction Act, respectively. It is hard for me to imagine that Europe would just sit by and quietly witness its own accelerated deindustrialization because of the externalization of low domestic demand in China. Now that is certainly interesting, isn't it? Europe doesn't want to seem to take the hit like the US did with losing their industrial empire. Boy, does that sound familiar, doesn't it? Orange man bad though, right? Now let's skip to the bottom of the article where the meat is. And again, remember, this is a year ago, while President Vegetables was still in charge. Trade tensions mount, CNN writes. Beijing is aware of China's overcapacity problem, acknowledging it is an issue for the first time in almost a decade at an annual meeting of senior officials in December. Now, my friends, for the Chinese government to actually admit this means the problem is much bigger than we think. But on the eve of this week's China Development Forum, several Chinese state-owned media outlets published editorials challenging the notion that China's supply glut poses a threat to other economies. For example, one news agency wrote, "What China exports is advanced production capacity that meets the needs of foreign consumers." But Washington and Brussels have a different view, however. U.S. President Joe Biden recently pledged to investigate whether imports of Chinese vehicles pose a national security threat. Well, golly gosh gee, isn't that exactly what Orange Man Bad has been saying? Of course, you won't hear about that now in the news media. Biden said, "A dynamic auto industry is vital to the U.S. economy." Well, you don't say. China is determined to dominate the future of the auto market, including by using unfair practices. China's policies could flood our market with its vehicles, posing risks to our national security. My, oh my, does this all sound familiar? But of course, we can't admit that now because Orange Man Bad. Now, why all of this matters, my friends, is that the U.S., despite all the cries of doom and gloom that we're getting now, you're going to see leftists and mainstream media people pulling their hair out, screaming and crying about these tariffs. But the US is actually in a good place right now to do this. And the reason why I can say this is we're going to talk about the US economy. Let's talk about US job growth. Much to the shock and surprise, and if we're being honest with ourselves, horror from the mainstream media, the United States is seeing steady growth in the job market. This comes despite the federal government slashing almost 100,000 jobs of federal employees last month. The U.S. economy still blew past expected job growth numbers. March saw non-farm payrolls rise by 228,000 jobs per the BLS, with the unemployment rate steady at 4.2%. This follows February's 151,000 job gain, showing a trend of solid growth in the United States. And the best part about this is, unlike during the Biden administration, the job growth is not being created by the federal government. It is private sector strength that drove all of this. For example, the healthcare industry added 52,000 jobs. Social assistance gained 11,000, and transportation and warehousing notched up another 18,000 jobs. And manufacturing is on the rise as well, thanks to Trump's earlier tariff policy focus. They also chipped in 10,000 jobs back in February. And though we don't yet have specific details for March, we can assume that there will be more gains in this sector. Now, cumulatively, from January to March, job growth has likely now exceeded 500,000 jobs in the private sector. January saw 143,000 jobs, February saw 151,000, and now with March at 228,000, this means that there are over 500,000 new private sector jobs created year to date. This is dwarfing federal cuts. And so, despite all the doom and gloom from the mainstream media about how the federal employees getting fired was going to doom the economy, we're seeing growth anyway. And with these numbers in hand, the USA is in an excellent position to win this tariff war, and win big. Countries are already coming to the table to find a way to make a deal with the US. We already have Mexico and Canada who are in negotiations after Trump suspended their 25% tariffs for 30 days. They are trying hard to keep the USMCA benefits intact given their reliance on US trade. For example, Mexico exports 80% of the goods up north, meaning here to the US. And in Japan, the prime minister is pushing for exemptions, citing the 24% tariff as regrettable. Japan's trade ministry is analyzing impacts, hoping to leverage its U.S. alliance and military ties to create a deal. And India also is making overtures to the U.S. They preemptively cut tariffs on U.S. goods like Harley-Davidson to appease Trump. But with $14 billion in electronics exports at risk, it is angling for pharma exemptions to balance the $46 billion trade deficit that Trump dislikes. And the U.K. is also working on a deal with the U.S., and clearly Trump is showing them a nicer hand than the rest of the world with only a 10% tariff. So expect there to be some kind of outreach from the UK to make a deal with the US. And breaking just minutes ago, Vietnam's leadership, I'm talking about General Secretary To Lam of the Communist Party, reportedly talked to President Trump today in a call and said that they are willing to slash their tariffs on the US goods to zero if they can strike a deal. So again, we are in the driver's seat right now, and all of this is thanks to our massive consumer base, our $18 trillion wallet that we spend every year that the rest of the world wants access to. Whichever country makes a deal with the U.S. first will likely end up being one of the biggest winners out of all of this. I expect that there will be a race to see who can make that deal first. And if we're really lucky out of all of this, we might see a revival of our industrial complex here in the U.S. But of course, only time will tell. And naturally, we'll be keeping an eye on this story as it continues to develop.